When a major expense arises, like a car, college tuition, for example, you borrow against your cash value to go make that purchase. You don't pay for it in cash or get a loan through a bank. You borrow against your cash value. Hey guys, it's Chris from the Hidden Reserve, and in today's video, what I want to be covering is why controlling the banking function beats chasing higher returns and how to multiply your dollars without chasing ROI. So let's just dive right into things. So first up, you're already financing everything. So whether you pay cash, you use credit, or you finance through a bank, you're financing every single purchase that you make. So when you pay with cash, that equals lost opportunity cost. Why is it lost opportunity cost? Because when you pay for something in cash, you no longer have the ability to earn interest on those dollars. So those dollars are essentially lost forever. And I'll dive into it more, but just to give you a quick example now, if I was to buy a car for $30,000 cash, yes, I own the car, I have no debt on it, but I lost the opportunity to earn interest on that $30,000. So that's just the example of paying cash. Next is using debt. So typically you're gonna go through a lender like a bank, you're paying interest to the banks when you do that. And then either way, whether you're paying cash or financing through a bank, money leaves your life forever. Like you're not gonna have the ability to earn interest on those dollars ever again. So some examples of where you do this, obviously cars, real estate down payments, college tuitions, weddings, etc. Next up, we're going to be covering the IBC approach, which is all about controlling the flow of money. So IBC is the infinite banking concept. If you're new to the channel, I have lots of videos talking about this. This is what the difference is by using IBC opposed to paying in cash or using other financing methods through debt. So here's what you do differently. Step one with the IBC approach is you save money consistently into a specially designed whole life policy. And by specially designed, what that means is you have a whole life contract that's designed for maximum cash value. Instead of trying to get as much death benefit as possible, we're trying to get as much cash value as possible. And also on top of that, the policy needs to be with a mutual insurance carrier, preferably one that's been around for 100+ years and has a really strong performance of paying dividends, so over a long period of time. That's what we're looking for. Step two, when a major expense arises, like a car, college tuition, for example, you borrow against your cash value to go make that purchase. You don't pay for it in cash or get a loan through a bank. You borrow against your cash value and get a loan from the life insurance carrier to make that purchase. So that's step two. Step three is as you're making that purchase with the loan from your cash value, the money in your cash value continues to grow as if it's untouched, and that's what's called uninterrupted compounding. So to expand further on that, if you have $100,000 in your cash value and you borrow against that, let's say you borrow $30,000 against that, your full $100,000 is still going to be earning interest and dividends in the policy. Meanwhile, you have $30,000 via a loan from the life insurance carrier that you can use to go purchase the car or pay for tuition, whatever it is. So the power there is that you have access to capital through the insurance carrier, but the money that's in your account, your cash value, is still growing as if you never touched it. So you don't get that by doing bank financing or paying for something in cash. You don't have your original money still earning interest on it and growing. So that's what's super powerful about this IBC approach. And then step four, you repay the loan on your terms. So when you get a loan against your cash value, there's no repayment terms there. You don't have to pay it back, over 60 months, you got to pay at this rate. You're the one that gets to decide how you want to pay that back. So you have a lot of flexibility there. And then step five is you reuse this system over and over again for life. So once you have the system set up and you understand it, that's where you can keep repeating this process over and over again whenever you need to make a major purchase, or if an investment opportunity comes up, you can use it for that as well. Next up, we're gonna really dive into comparing traditional financing versus IBC. So in this chart here, I have on the left side the traditional path, and then on the right side, IBC path. So first up, with the traditional path, when you make a purchase, money leaves your hands. And with IBC, your money stays in compounds, like I talked about. When you go to make a purchase and you borrow against your cash value, that money's not leaving your account. It's still in there earning interest and dividends, and now you've got a loan from the insurance carrier that you can use to finance whatever it is. So that's the biggest difference there. Next up is with the traditional path, the bank will make the terms. So if you get a loan from a bank, you're not in control of those repayment terms. And then with IBC, you create your own repayment terms for the loan. The other thing is with the traditional path, you lose liquidity. So if I'm financing through a bank or paying cash, I don't have that liquidity anymore. I don't have the ability to access those dollars once it's used. And with IBC, you stay liquid. Again, when I borrow against my cash value, my dollars are not being removed from my account. I still have access to those dollars. That money's still working for me. But if I were to, again, pay cash, I lose the ability to earn interest on that money forever. So that's a huge difference there. And then the last thing here is with the traditional path, you have zero long-term gain, meaning you no longer have those dollars in your system earning for you. You give up the opportunity to earn, whether, again, paying cash, those dollars are gone. Bank financing, those dollars are gone. And then with IBC, it's a lifetime asset because your money is going to continue to grow and compound inside of the policy, your cash value. And also you have the legacy component of it as well through the death benefit. So that's the main difference between going a traditional financing route versus using IBC. Next up, I want to do a case study. So in this example, we're going to be doing a $30,000 car. So option one to purchase this $30,000 car is you can pay cash. And we'll walk through what that actually looks like. So if I'm paying cash, $30,000 is spent to acquire the car. Money is going to leave my hands permanently because once I pay that $30,000 for the car, I no longer have that $30,000 in my hands, obviously. Number three is there's no return on that money. So we're strictly talking about the capital itself, because arguably you could buy a car and you might be able to make money on that if it's like a collector's car or something like that, but that's not what we're focusing on. We're strictly focusing on the capital itself. There's no return on it because I just gave it up to go buy that car in cash. And then if you look at what that $30,000 could have earned over a 30-year time frame, it's essentially $97,000 and change loss if that $30,000 was earning 4% year over year for that 30-year time frame. So just the simple fact that that $30,000 has left my hands and is gone forever, the opportunity cost loss there was potentially $97,000. Again, assuming that $30,000 was earning 4% year over year. And that'll tie into the IBC path later on. So next up is option two. So same $30,000 car purchase, but in this case, we're gonna get a bank loan. It's a 5-year term and there's gonna be 6% interest on that loan. So the monthly payment in this case will be $580.54. And after the 5-year term, the total amount paid would be $34,832.40. $4,832.40 of that is interest paid to the bank. And the downside to this method is there's no asset growth, there's no control, and there's external approval required. So no asset growth means, again, it's similar to paying in cash. You don't have the $30,000 that's in your control that you're earning interest and dividends on. It's not growing over time. No control. In this case, you have no control over the loan. The bank is in control of the loan repayment terms, and then external approval required. You might not even be able to get the loan. You have to qualify for it through the bank. So that's really the downside, and I guess the comparison to using a bank loan to paying in cash. And then next up, we're going to be going over using IBC for making the car purchase. Again, same exact thing, buying a $30,000 car. Instead, we're going option 3, using a policy loan from an IBC style whole life policy. So what does that process look like? So I'm going to borrow $30,000 against my cash value. And just a side note there, you need to make sure you have enough cash value in your policy to even do this. So the $30,000 example, I mean, you're gonna have to have at least like $40,000, $50,000, if not more, in your policy to have $30,000 available to borrow against. So that's really important to keep in mind. Next up though, the policy continues to earn uninterrupted compounding when I take that $30,000 loan against it. Really powerful. And in this example, we're going to make the same repayment as the bank. So $580.54 a month for 5 years. And after after 30 years, the $30,000 left uninterrupted, earning 4% in my policy would grow to $97,307. So that's assuming too, I'm not adding any new premium to my policy. And that's not factoring in reinvesting dividends in my policy either. I wanted to try to keep it apples to apples as much as possible. So really the amount of money you have in your policy is going to be significantly more than this $97,000, but that's just showing the recapturing of that interest in your policy if you had your policy to finance versus paying cash or getting a bank loan. And then the next point here is all while you still drove the car. So the power of this is you just successfully paid that car in cash. You had the money in your policy continuing to earn interest and dividends and grow. And then at the end of the day, after you repaid that loan, you have a policy cash value that appreciated. And now you have that car that you own outright because you paid it in cash through the policy loan in the beginning. So that's where it's really, really powerful. If you use IBC the right way, is you're gonna have this guaranteed asset that grows over time, and then you also use that as a financing tool to acquire something like a car. So it's really powerful. So just a summary on buying this $30,000 car, I compared all 3 in this chart here, and I'll go through it pretty quickly. And I have the method, which is how you're financing it, the total amount paid, the wealth retained, growth, and then notes explaining each method. So I'll do one by one. So with cash, you paid $30,000. With the bank loan, it was a total of $34,832. And then it was the same for the IBC loan. For wealth retained with cash, you have $0 left. You paid $30,000 for the car. That money's gone. It's not working for you anymore. For the bank loan, same thing. Wealth retained is $0 because you had to finance it through the bank. It wasn't your money and you don't have that money working for you. With IBC, the wealth retained was $97,307. And again, that's just assuming that $30,000 was earning 4% year over year for a total of 30 years. That's where that number comes from. The growth for cash was $0. Again, that money left your hand. Same for the bank loan, it's $0. And then with the IBC loan, did you get growth? The answer is yes. You got growth because that money was working in your policy every single second of you having that, or every single second of you having purchased that car. And then notes on it for the cash method. After purchasing the car, you have no money left. With the bank loan, you purchased the car, but you lost $4,832 in interest. And then with the IBC loan, you have the car and you also created 6 figures plus in cash value over that time frame, or over the 30-year time frame, because that money never left your own policy, it never left your system. It continued to work for you during that period of time. And then really the key insight here is the cost of lost opportunity is far greater than the interest you save by paying cash. And again, there's nothing wrong with paying in cash, but there is a better way once you understand this, which is utilizing the infinite banking concept. To recap, I pay cash, I pay $30,000 for the car, I own the car, I owe no money on the car. but the thing is that $30,000 is gone. It's not working for me anymore. So it's really important to see the difference there. So why this works is there's 3 core mechanics to this process. So number 1, the biggest one that I've talked about is uninterrupted compound growth. So your cash value grows even while you borrowed against it to make a purchase, and your capital is going to keep compounding permanently inside of this policy. Next up is the control and liquidity piece. So you control the repayment terms on the loan. So in this example, I use the same repayment term as the bank. You don't have to do it that way. You could have repaid that car loan over 30 years, for example, or 20 years, however you wanted to structure that. I just wanted to compare apples to apple, but ultimately you're in the driver's seat on how you want to make that loan repayment. And then the next thing is you can access your capital without qualifying or without penalty. So like a bank loan, you have to qualify for the loan. To access or to get a loan against your cash value, there's no process to do that. You can do that pretty much immediately, and there's no penalty for accessing your money early. You don't have like a 59.5 rule or anything like that. Typically, it's about 30 business days before you have access to your cash value. So if you just set up a policy, day 1, you're not going to be able to borrow against it or access those funds, but usually about 30 business days is where you'll have the ability to access those funds in your policy. And then the third thing here is you retain more of what you spend, which is ultimately the theme of this PowerPoint. So instead of losing interest to banks, you keep it inside of your system. So side note there, and this is where there's a lot of misconceptions online, is you're not paying yourself back essentially because you have a loan from the insurance carrier and they're charging you interest. So you're gonna have to pay the insurance carrier interest, but the difference is you have your cash value and your policy earning interest and dividends on it. So it could be a spread, or it could be a wash where the growth in your policy cancels out the interest rate that you're paying to the carrier, or you might pay a significantly less interest rate if you're factoring in what did my policy earn and what did I have to pay out in interest to the bank or the insurance carrier. Or it might be a scenario depending on, everyone's different depending on how your policy's set up, where it's at in cash value. You might have a scenario where you're actually making a little bit of a spread there. So that's very important to just know, is that you're not paying yourself interest. The interest is going to the insurance carrier, but while you're doing that, you're still earning interest and dividends on your money and your cash value. And then I put here, it's not just about earning a better rate of return, it's about controlling the flow of your money. And I'm going to dive into it more, but it's so important that you're capturing and controlling a larger pool of your money versus just going out there trying to get the highest return possible on your money. There's a big difference there that I'll touch on in a couple slides. And then last point for this one is I put, you'll touch hundreds of thousands, even millions over your lifetime, and IBC helps you keep it. So a couple slides later, I talk about how you're going to be, in terms of big purchases, you're going to be spending hundreds of thousands, if not millions of dollars. And this is a way to allow you to retain those dollars and continue to earn interest and grow that money for the rest of your life in this type of system. So next slide is the real profit isn't in the ROR, the rate of return. So this is really important because naturally we think, oh, we want to get the highest return possible, but we don't think about what are ways that we can keep more money and retain more money and have that money work for us for the rest of our lives. It's all about what you keep, not necessarily what you earn. You probably have heard that a lot. And this specific angle of keeping more of what you are, keeping more of your money, is a lot different because yes, you can minimize, there's ways to minimize taxes and stuff to retain more, but this is allowing you to retain money that you would have to use to fund purchases, which is a lot different. So let's dive into this slide here. So let's say over your lifetime, you spend $300,000 on cars, $500,000 on real estate down payments, $100,000 on education, and $100,000 on emergencies and big expenses. That would be $1 million in major purchases made over your lifetime. Again, there's three different options that you could, or three different paths, if you will, to finance those things. Option A, pay cash or use bank loans, and that money is gone forever because it's leaving your hands, or you're going to be paying interest to someone else, the bank in this case. Option B is you can use a whole life insurance policy, which is set up for infinite banking. So you're going to borrow against your policy for those same purchases. Your $1 million would stay inside of your policy, growing uninterrupted for you. You can pay it back on your terms, and assuming a 4% net compounding on that $1 million, it would have grown to over $2 million if we're looking over not essentially a full lifetime, but over 40 years. Plus, you still got everything. You got everything you needed. So whether it was purchasing the car, let's just say everything on this list, you have all of those things, and you also have the money in your policy growing for you, which is really powerful. And the bottom line is, it's not about getting a better return. It's about keeping your dollars in your system where they can work for you forever. And I have in quotes down here, you don't need a better investment, you need a better system. And I'll dive into it more, but you don't have to. Think about it this way. Would you rather earn 4% on $100,000 or earn 8% on $20,000? Obviously, it's going to be earning 4% on $100,000 because you're earning a less percentage, a smaller percentage, but that percentage is on a larger pool of money. And that's the whole point of this concept, is you want to retain more of your dollars so that you don't need to chase a higher return to get the same amount of money. So that's something, it took me a minute to wrap my brain around that, but once I saw the numbers and saw the concept through, it's like, wow, that makes a lot of sense. It's like, I can take less risk in my investing and come out ahead in some cases because I'm retaining more of my money and I'm consistently getting a rate of return on that for the rest of my life. Next slide, I want to tie in biblically how the infinite banking concept, how everything we're talking about ties into the Bible. And in the parable of the minas, which is in Luke chapter 19, Jesus gives three clear financial paths. So number one, the servant could do nothing, he buried his money in the ground. Number two is you could give it to the banker, which is passive stewardship, and it's outsourced investing essentially, the way I look at it, because you just give the banker your money, you'll get a rate of return. And then number three was be the banker. You can be in control and actively multiply what you've been entrusted with. And what IBC allows you to do here is, one, keep your money working for the kingdom by keeping control of it in your own policy inside your own system. Number two, be in control of how it's used. You call the shots on how you can access what you want to access and use your cash value for. Number three, you can multiply what God has entrusted you by retaining dollars inside of your policy. You're not only earning interest and dividends there and growing it, you can strategically use the policy loans for other investments and multiply the money through that as well. So internally, you're earning interest and dividends, growing your money, which is the policy. And then externally, you're making investments with the loans to grow that money as well. And then the last point here is you leave a tax-free legacy for future generations. So once you pass away, with the policy, you're going to have that death benefit, and that's going to get paid out income tax-free to your family. Next slide here. Most people chase rate or rate of return, but lose control. So traditional advice is max out your 401k, invest in mutual funds, pay cash for everything. But with the IBC, the reality is the rate of return doesn't matter if your cash flow keeps leaking. So if you're making these purchasing cash or you're chasing these higher returns, that money is leaving your hands, and you're also taking more risk to get more bang for your buck essentially and risk your investments. And I'm not opposed to doing that. It's just coupling the two together. It's having a safe system like this to grow your dollars and also taking risk to make investments as well. Second point here, IBC puts the entire financial flow under your control. So since you're retaining those dollars and you're capturing that money in your system and you have the ability to call the shots, you're the banker in this case, and you can choose how to direct those dollars. And then last point here is even better when used for things you are already going to buy. So what I mean by that is when you have this system in place, it just enhances your financing, because if you were going to buy a $30,000 car anyway, might as well finance it through your own system where you retain that money, it grows for you, and you also can purchase that vehicle in this case and own that. So you own the car and you own the system that's going to allow those dollars that you were going to use anyway to purchase a car to grow for you for the rest of your life. So next slide, recap from returns. So you're already going to buy cars, fund real estate, pay for education, cover emergencies, and buy equipment, let's say for your business, if you're a business owner. And you have those three choices. You can use cash where the money is completely gone forever. You can use banks and pay them interest, or you can use IBC, keep that money growing for you on a guaranteed basis, might I add, and recycle it over and over forever. And with this system, the next slide is it only gets better over time. So the early years, you have smaller benefits. If you're not familiar, check out other videos on my channel talking about this, but the worst year of a life insurance policy is the first year. No matter how you set it up, you're going to take a pretty big hit on your money, maybe 15% or even a little bit more depending how it's structured. So you're going to take a hit on your money in year 1, and it's usually around year 5 where you're going to hit your break-even point, meaning the premiums you saved into the policy is going to be equivalent to the cash value, or the cash value is going to be equivalent to that, if not a little bit more. So if you paid in 500 grand over 5 years, you should have at least 500,000 in your cash value, if not a little bit more by that point in time. So that's really important to be aware of. And with this system, after 10 to 20 years, that's where you'll really see the massive compounding and the power of doing internal financing. So it's a long-term strategy, and you have to be in this for the long haul to really see it out and see the power of it. Number 3 is retirement. So with this system too, we've been talking about financing. You could use it for supplementing retirement income, because your policy, if it's set up properly, it's going to become a tax-free income stream for you. Where the tax-free part comes in is you're not withdrawing the money from your policy, you're taking loans against the cash value, and since it's a loan, obviously it's debt and there's no taxes you have to pay on that. Side note there, you could withdraw up to your cost basis or the premiums you put into the policy without paying taxes on that as well, because there's no gain there. It's your basis, it's what you put in. So that's where the tax-free retirement piece comes into play. It's a combination of withdrawing your basis, your premiums that you put in, and also taking loans against the cash value. And then the last piece is the legacy component. So there's a large income, depending on the policy size is different, but you could leave potentially a large income tax-free death benefit to your family, and also causes, churches, ministries, other funds out there. You can decide how you want to direct that death benefit, how you want to piece it up essentially. The final takeaway here, and I have it in quotes, is you build wealth not just by earning more, but by keeping more of what flows through your life. So to further expand on this, it's not just about earning a rate of return through investments, which is important. It's also about how can I keep as much as my money possible, and how can I keep it earning and growing for me for the rest of my life. And the reason why IBC is so powerful is it's all contractually guaranteed to happen. So yes, you get, in most cases, if you're working with a mutual carrier, you're going to get a dividend. And if you're working with a strong mutual carrier, they have a track record of paying dividends for over 100 years plus. So yes, the dividend part's not guaranteed in the contract, but if you're working with a carrier that's paid dividends over 100 years plus, it's almost guaranteed to happen. But let's say you don't get a dividend, you're still going to get a guaranteed rate on your money. So if you can retain more money in your system and have that money grow guaranteed for you forever and you have access to it, that's where this system is very, very powerful. So I hope you learned a lot from today's presentation. Again, the next step would be book a discovery call with me. I'll have a link in the description of the video, or you can reach out to me via email. You'd see the contact info on the screen here. If you have any questions, book in a call with me there. We can look at your numbers, see if it makes sense. We can design a system custom for you. It's gonna look completely different for everyone. But book a call if you wanna learn more, see what the next step might be for you. And if you have any questions, you can email me, you can leave them in the description or the comments of this video. Please share the video if you found benefit from it, like the video. I'll have a lot more educational content coming out every single week, so please subscribe if you haven't already. And I hope you enjoyed. I'll catch you in the next video.